Turning to the broader financial landscape, one of the most pressing topics right now is the possibility of a United States government shutdown. The odds of a shutdown by October 1st have surged sharply over the last several days, climbing to 73% and at one point reaching 80%, according to prediction market data. This spike has caught the attention of investors and economists alike, as a government shutdown can create ripples across markets. The big question that now hangs in the air is how equities and crypto will respond if Washington once again grinds to a halt. Early polls suggested a 65% chance of a shutdown, but that figure has since risen. Interestingly, more than half of survey respondents, around 53%, believe that such an event would barely affect the markets at all, calling it essentially a nothing burger. In other words, many traders think the drama in Washington will have more of a psychological than financial impact. Politically, the debate has already become heated. Senator Elizabeth Warren recently framed the standoff as a moral battle worth fighting, arguing that the government should not back down and that the stakes are too high to compromise. She emphasized the need for Democrats to stay united and push for what she called righteous fights that matter to everyday Americans. However, critics see her optimism as misplaced. Analysts predict that Democrats will likely be the first to yield under pressure, given the potential political and economic fallout of a prolonged shutdown. Most experts agree that if the government does close, it will likely be for less than a week. Any shutdown lasting longer than that could start to trigger nervousness across financial markets, prompting sell-offs in both traditional and digital assets. Another issue tied to the potential shutdown is the effect it could have on key economic data. The Bureau of Labor Statistics has already announced that it would suspend the release of crucial indicators, including the monthly jobs report, if the government shuts down. For traders and analysts who rely heavily on these reports, this would create a temporary data blackout. Many investors already view the BLS data with skepticism, citing frequent revisions and perceived inaccuracies. But even with those concerns, the absence of fresh data could heighten uncertainty. In past shutdowns, similar pauses have led to short bursts of volatility in both the stock and crypto markets. If the shutdown remains short-lived, markets may shrug it off, but a prolonged freeze could easily shake investor confidence. Beyond politics, trade tensions are once again creeping into the economic picture. Former President Donald Trump has recently revived his tariff rhetoric, proposing substantial tariffs on countries that do not manufacture furniture within the United States. Such a move could drive up consumer prices and strain global trade relationships. Even more surprising was his suggestion of a 100% tariff on movies made outside the US, a statement that raised eyebrows given that much of Hollywood's production occurs overseas. Whether these comments represent actual policy plans or mere posturing remains unclear, but any serious trade restrictions could have wide-ranging implications for global supply chains and entertainment economics alike. Meanwhile, global monetary policy is undergoing a major pivot. Over the past 12 months, central banks around the world have collectively issued more than 160 interest rate cuts, signaling a clear shift toward monetary easing. Now, the US Federal Reserve has joined the movement, beginning with a 25 basis point cut and hinting at as many as 3 more reductions before the end of the year. This wave of rate cuts could breathe new life into financial markets and increase liquidity, particularly in risk assets like technology stocks and cryptocurrencies. The question, however, is whether the economy has already entered a stage of mild stagflation, where growth stagnates even as prices remain elevated, or whether these cuts will successfully reignite expansion. A government shutdown would also slow progress on cryptocurrency regulation. The much-anticipated U.S. crypto market structure bill, which aims to provide clearer rules for digital assets, is likely to be delayed until December or early next year. The Senate Banking Committee has already postponed its markup hearing from early October to late October. This delay comes just as the Federal Open Market Committee prepares for its next meeting, making timing all the more delicate. Despite this uncertainty, investor sentiment in the crypto space has been slowly improving. The Fear and Greed Index, a measure of market mood, recently rose from 32 to 39, suggesting a gradual return to optimism as Bitcoin and other major tokens rebound from recent lows. At the same time, the Securities and Exchange Commission faces a packed October calendar with 16 different crypto ETF applications awaiting decisions. Market watchers believe several of these will be approved, possibly ushering in a flood of new investment vehicles. Bloomberg analyst Eric Balchunas has gone as far as to predict that more than 100 crypto ETFs could enter the market within months. This could dramatically increase institutional exposure to digital assets and potentially spark the next leg of the bull cycle. Many in the community are already referring to the coming months as Uptober, Moonvember, and Pumpsember, hinting at the optimistic mood reminiscent of past cycles. While some dismiss this as wishful thinking, liquidity data and macro trends both point to a strong final quarter of the year and potentially a bullish first quarter of 2026. Adding to the optimism, BlackRock's chief investment officer recently commented on what he called pockets of irrational exuberance within the market. He clarified that he does not see these as signs of a widespread bubble, but rather as examples of selective mispricing, conditions that can create opportunities for skilled investors. He also emphasized that the current market is on firmer footing than it was during the late 1990s tech boom. The composition of investors has shifted toward a mix of high-frequency traders, retail participants, and algorithmic systems, all of which contribute to short-term volatility, but also to deeper liquidity. This environment, he argued, is favorable for stock pickers who can spot undervalued opportunities in the chaos. The host of the program agreed, noting that while speculative pockets exist, the overall market appears far healthier than during the dot-com era. Cathie Wood of ARK Invest also joined the conversation with her ongoing thesis that Bitcoin remains the most significant digital asset in existence. In her view, Bitcoin represents both a revolutionary technology and a new global monetary system, a decentralized network that has never been hacked and continues to serve as the benchmark for trust and transparency. Ethereum, meanwhile, plays a different but equally critical role as the foundation of decentralized finance. Wood acknowledged Ethereum's importance in powering DeFi applications, though she cautioned that competition among Layer 2 scaling solutions could eventually dilute some of its dominance. Nonetheless, she remains invested in both assets, viewing Bitcoin as digital gold and Ethereum as the infrastructure layer for a new era of financial services. The discussion then turned to the rapid growth of on-chain credit markets. Coinbase's USDC lending platform has seen explosive adoption recently, marking the early stages of what could become a massive shift in how global credit is managed. Protocols like Morpho now allow users to lend and borrow seamlessly through blockchain-based smart contracts, effectively creating decentralized credit systems that bypass traditional banks. These developments, unlike short-lived NFT booms, represent lasting infrastructure changes. As blockchain-based lending, tokenized securities, and real-world asset integrations continue to expand, Ethereum is likely to remain the backbone of this new financial ecosystem, supported by stablecoins that function as digital cash equivalents. All of these factors, rate cuts, potential ETFs, regulatory shifts, and on-chain innovation, suggest that the crypto market is entering a new phase of maturity. investors are no longer just chasing short-term hype. They are positioning themselves for the evolution of decentralized finance and digital infrastructure. If current trends continue, the next 12 months could mark a defining moment not only for crypto but for the global financial system itself. For ongoing updates, deeper analysis, and strategic insights, viewers and readers are encouraged to join the Diamond Circle community, where exclusive content and market outlooks are shared regularly. As always, Paul Barron and his team remain focused on helping investors navigate this rapidly changing landscape and identify where the next major opportunities will arise in both traditional markets and the crypto economy.